And what a week we had in the precious metals markets. There was a lot of volatility. We had the FOMC meeting and decision on Wednesday. We had a lot of action in the market today with a quadruple witching day with expirations of futures and options and all kinds of stuff like that, adding to some of the volatility. But all of it basically very bullish for gold to the upside. Gold finished the week up another 1.1%, not at a new record high, but just barely. I mean, we closed in gold right below 36.90, maybe 36.85. We touched 3,700 a couple of times.
Gold just closed near a record high. Silver just smashed through a level we haven't seen in 14 years. And now Wall Street itself is telling its clients to dump bonds and buy gold. Let that sink in. We are witnessing a seismic shift in financial markets that could make your gold and silver holdings almost priceless. This week's FOMC meeting, the surprise rate cut, and the explosive rally in gold and silver miners were not random events. They were a signal that the system is moving into a new phase. Peter Schiff is warning that this is just the beginning. The dollar is getting weaker, bond yields are spiking, and for the first time ever, a major U.S. investment bank is telling its clients to sell half of their bonds and buy gold instead. This isn't some fringe prediction anymore. It's becoming mainstream. If you own gold, silver, or mining stocks, you are sitting on what could be one of the biggest wealth transfers in modern history.
I have a feeling we'll gap above it on Monday and maybe never look back. Silver was even stronger, up 1.8% on the week, but all of that gain today, because today's move in silver was 2.8%. So meaning silver was actually down 1% on the week going into today, and it closed up 1.8% because of a 2.8% move. Silver actually closed just above $43 an ounce. So we hadn't even been above 43 in 14 years, and now we closed above it. Year to date, just to put these gains in perspective too, gold is now up 40% this year alone in 2025. Silver is up 48%. These are incredible returns for precious metals, especially given that last year was also a very good year. But the only thing that's outperforming gold and silver are the gold and silver mining stocks. Today alone, both the GDX and the GDXJ jumped 5%. 5%. We didn't even have really a 1% gain in the price of gold. Or almost, I guess it was about 1% because it was $40, so a little over 1%, but 5%. So we had 5 times the move in gold stocks today as we had in gold. And the GDX closed at an all-time record high, never been this high. And the GDXJ is the highest it's been in 13, 14 years, something like that. On the week, the GDX was up 3.75%. And the GDXJ was up 2.2. The star of the day was Barrick Gold, which was up 10% in one day. That's rare for a company that big to be up 10%. Normally, you might see some smaller companies, although all the gold mining companies are small when you compare them to like the tech companies. But in the mining universe, Barrick is, I think, the second biggest, following Newmont, which was still up almost 5% on its own today, so not too shabby there. But these are all big moves. Year to date, the GDX is now up 113%, and the GDXJ is up 115%. Right, so these stocks are doing better than tech stocks. Newmont is the best performing stock in the S&P 500, but you would not know about that if you listen to the mainstream financial media. In fact, there was very little, if any, talk at all today in the mainstream financial media about gold stocks hitting, new all-time record highs. Nothing. They did focus on the S&P hitting a new record high. Sure, the S&P made a record high. Year to date, the S&P 500 is up 13.3%. 13.3%. Gold stocks are up 10 times as much. 10 times as much. So what's the big deal? And in fact, if the S&P is up 13%, but gold is up 40%, what does that tell you? That means in real terms, the S&P is down 27%. This is a major bear market in stocks if you price them in real money. But nobody's pricing them in real money. They're pricing them in funny money. And so you're getting an inaccurate perspective. Now, in other markets that were significant on the week, the dollar was actually only up slightly on the week. I think that's going to reverse, but it's still very weak, the dollar index. What was also up were bond yields. Again, I was forecasting that when the Fed started to cut again, long-term rates would rise, and that's what's happening. The yield on the 10-year finished the week at 4.13. On Tuesday, the day before the rate cut, it was 4.02. So the Fed cut by 25 basis points, and the long end has already gained about half of that. It'll probably gain the other half next week. The yield on the 30-year is 4.74. Now, I want to talk about some of the significant things from the week. The first one, of course, is the rate cut. I don't want to spend any time on this market wrap on the rate cut because on Wednesday, after the stock market closed, I recorded a Peter Schiff podcast, and I spent almost an hour discussing not only the rate cut, but the incredible admissions that the mainstream media didn't even cover from the press conference. It is
This past week was one for the history books. We had the Fed cut rates by 25 basis points, taking the federal funds range down to 4.00 to 4.25%, and signal another 50 basis points of cuts before year-end. Jerome Powell called it a risk management cut to deal with a weakening labor market. But Peter Schiff says it's much bigger than that. Lower interest rates slash the opportunity cost of holding gold and silver, and that is exactly why both metals surged. Gold finished the week just under $3,700 per ounce, up 1.1%, and flirting with a new all-time high. Silver exploded 2.8% in a single day, taking it above $43 for the first time in 14 years, turning a weekly loss into a gain of 1.8%. Year-to-date, gold is now up roughly 40%, and silver nearly 50%. That's not just a bull market. That's an absolute breakout. But the real story might be in the mining stocks. The GDX and GDXJ jumped 5% in a single day, with Barrick Gold soaring 10%, an astonishing move for a company of that size. Year-to-date, GDX is up 113% and GDXJ 115%, making them some of the best-performing assets on the planet, even beating tech stocks. And yet, mainstream financial media is still talking about the S&P 500 like it's the star of the show, even though in real terms, priced in gold, stocks are actually in a bear market. Schiff points out that Morgan Stanley just changed its sacred 60-40 portfolio model, telling clients to cut their bond holdings in half and replace them with gold. This is a game changer. For decades, Wall Street told everyone to own zero gold. Now they're saying you should hold 20% of your portfolio in it. That is going to create massive demand for physical metal at a time when supply is tight and deficits in silver are heading into their 5th consecutive year. UBS is already projecting silver to hit $44 by year-end and $47 by mid-2026, with ETF inflows adding over 20 million ounces just this quarter. This is why Schiff believes quantitative easing is coming back sooner than most think, because as bond prices drop and rates rise, the Treasury will be forced to find buyers for its record-setting debt issuance. When that happens, it will pour even more fuel on the fire for gold and silver.
Policy regarding the dollar, that lies with the president, right? Not the Fed, which should be very scary because if the Fed doesn't care about the value of the dollar, how is it going to deliver on its primary mandate of price stability? Because price stability relies on the stability of the dollar, because prices are a function of the value of the dollar. If the dollar is losing value, you need more dollars to buy stuff. So in a way, when the Fed is mandated to maintain price stability, it is also being mandated to maintain the purchasing power of the U.S. dollar. So to say that the dollar is not a part of the Fed's mandate either means you don't understand what the Fed's mandate is, or you're just lying. And so either, it's one or the other, but there's no, third option. So he's on the Fed, and Trump is going to appoint a new Fed chairman that is going to share that perspective. In fact, one of the president's closest confidants, or was at one time, Steve Bannon, he came out this week in favor of the president nominating Scott Bessent to be Fed chairman while he is still Secretary of the Treasury. In other words, Scott Bannon thinks that the chairman of the Federal Reserve and the Secretary of the Treasury should be the same person. One guy wearing both hats, or gal, depending on who's there. That is a horrible idea. I mean, often those two work together, but they shouldn't. There should be like a Chinese wall there. In fact, the Secretary of the Treasury, of the Chairman of the Fed, needs to push back against reckless monetary deficits and fiscal policy. They shouldn't be working together, and certainly they shouldn't be the same person. But that's what they're advocating. So this is a real collapse of the perception of Fed independence. Even if the Fed wasn't independent, there was a general belief that it was. And now that's falling apart because they're pulling back the curtain and they're showing everybody that there really is no Fed independence. So I think the dollar is going to tank, but more significantly, gold is going to rally and rally big. And one of the reasons for that is Morgan Stanley just the other day, I think it was either Wednesday, maybe Thursday, but Wednesday, they came out and they officially adjusted the 60-40 portfolio. Now, the 60-40 portfolio is kind of like a mantra on Wall Street. It's how everybody should allocate their investments between stocks and bonds. And the benchmark is 60% stocks and then 40% bonds. And the only time they tweak it is as you get a lot older and you're retired, they will reduce the stock portion and increase the bond portion. But the standard cookie cutter model is put 60% of your portfolio in stocks and put 40% in bonds. Well, Morgan Stanley came out and said, we think that needs to be changed to a 60-20-20 portfolio. Still 60% stocks. They are reducing the bond allocation. They're cutting it in half. And they are replacing the half that they cut out with gold. So now you have a major U.S. investment bank telling its clients that now have 40% of their portfolio in bonds, that they need to sell half of their bonds and buy gold, right? Because the only way you can go from 40% bonds to 20% bonds is to sell half of your bonds. So in effect, what Morgan Stanley just did is they put out a sell recommendation on U.S. Treasuries, because U.S. Treasuries represent a pretty big part of that 40% that is allocated to bonds. Now, this couldn't come at a worse time for the Treasury, because the U.S. Treasury now has to sell a record amount of bonds, right? We have unprecedented deficits that were just exacerbated by the big, beautiful bill. Yet investors, if they follow the advice of Morgan Stanley, and if more major brokerage firms and investment banks follow their lead, because Morgan Stanley said that you need to do this as an inflation hedge, right? It's clear that inflation is going to be much higher than 2%. It's been above 2% for the last 5 years. The Fed doesn't even forecast it to get down to 2% for another 2. That's 7. And of course, that forecast is all BS. And I went over that in my other podcast. So I don't want to kind of steal that thunder. You got to watch it, because it's a startling observation that I made about a startling admission that nobody else is covering. But given that inflation has been so high for so long and likely to go higher now in light of the Fed's decision to cut rates, Morgan Stanley is saying you need an inflation hedge. You need to hedge your bonds. You can't have 40% bonds. You can only have 20% bonds. Now, I don't want any percent of my money in bonds, and so I'm already in gold and silver mining stocks. But most of Morgan Stanley's customers don't own any gold. And now they've been told for the first time to have 20% of their portfolio in gold. That's a lot of gold when you have zero. So Morgan Stanley clients and maybe other clients who are going to maybe get similar advice as the weeks and months go by, they have to sell all their bonds or half their bonds and buy a bunch of gold. So what does that mean? Well, first, for bonds, it means lower bond prices and higher interest rates, which also means higher mortgage rates, the opposite of what Trump is trying to achieve by pressuring the Fed to cut rates. So what does that mean? That means quantitative easing is coming next, right? Because that's the only way that they're going to get, at least in the short run, long-term rates to go down and mortgage rates to go down.
This is why Peter Schiff says your gold and silver holdings could soon become almost priceless, because the financial world is waking up to the fact that fiat currency is losing credibility fast. So here's my question to you. Do you think we are entering the final stage of this precious metals bull market? Or is this just the beginning of a multi-year rally? Will gold and silver overshoot all expectations before peaking? Or do you think we see a pullback first? Drop your honest thoughts in the comments below. I want to know what you're seeing on your end. If you found this recap helpful, smash that like button, share this video with other stackers, and subscribe with notifications on so you never miss a market update. The next move in gold and silver could happen overnight, and you'll want to be ahead of it.